Introduction. Stock ETFs get criticized all the time. You hear it from every direction. They're not really diversified. There's way too much US exposure in there. They're super risky. They can drop 40 or even 50%. Or the ETFs don't even hold the stocks they claim to. And honestly, a lot of these arguments do sound convincing at first. Especially if you're new to the world of ETFs, it can quickly feel like a warning. Stay away or you'll lose your money. That's exactly why today we're taking a close look at 6 of the most common criticisms of stock ETFs, and we're going to break them down one by one. And yes, we'll stick to our view. We recommend stock ETFs as a long-term wealth-building tool. If this video helps you feel more confident about investing, make sure to subscribe, hit the bell, and leave a like. Let's jump in. 1. Stock ETFs are dangerous. They can fall 30 to 50%. Yes, that's absolutely true. And that's exactly why it's so important to understand how the stock market actually works, not just on the surface, but at its core. Here's the truth. Stock ETFs are one of the strongest asset classes in the world because they fluctuate. Volatility isn't a bug, it's a feature. Take the 2020 COVID crash. The MSCI world dropped over 30% in just a few weeks. Many beginners panicked. Some sold immediately. And here's the crazy part. Just a few months later, the market had fully recovered. Anyone who bailed out missed the entire rebound. Or look at the 2007 to 2009 financial crisis, almost 50% down. Sounds dramatic, and it was. But if you zoom out and look at the full long-term chart, you realize it was just a chapter, not the whole book. Long-term investors benefit from global economic growth. Companies innovate. People spend money. New markets emerge. If you accept volatility, you start thinking like an investor, not like a saver. Savers want safety. Investors want returns. You rarely get both at the same time. 2. What if the stock market crashes forever? This question comes up a lot, and it comes from fear, not logic. Imagine the stock market falling permanently, not for months or years, but for decades. What would that mean? Companies stop making profits. Banks stop issuing loans. Innovation dries up. Jobs disappear worldwide. Governments lose tax revenue. In short, our modern economy would collapse. Now ask yourself, how likely is that? Even during world wars, pandemics, oil crises, inflation, political upheavals, technological shifts, and dozens of crashes, markets have always recovered, not by coincidence, but because growth is a fundamental feature of human economic activity. As long as people have ideas, companies solve problems, and innovation shapes the markets, stocks will rise in the long run. This has been true for over 150 years. 3. ETFs aren't diversified. They're basically all US and tech. A lot of people are shocked when they learn that the MSCI world consists of roughly 74% US stocks. And yes, that number is high. But the real question is that actually a risk? The reality is, Apple, Microsoft, Amazon, Alphabet, and Nvidia are American companies, but they earn money all over the world. These companies dominate globally, in Europe, Asia, South America, everywhere. For example, more than 1/3 of Apple's revenue comes from China. Microsoft earns massive amounts in Europe. Amazon's AWS business makes billions worldwide. Is the tech share high? Yes, but technology is the backbone of our modern economy. Software runs our cars. AI is changing every industry. Digitalization is everywhere, and sector rotations in the index are totally normal. 20 years ago, oil dominated. Before that, banks. Before that, industrials ETFs simply reflect economic reality. 3. ETFs aren't diversified, and you're all US and tech. Continued. Here's a point many people underestimate. For decades, the US has created the most successful, valuable, and innovative companies in the world. Why? Huge domestic market risk-tolerant investors, tech-friendly culture, strong universities, massive venture capital ecosystem, globally dominant brands. So if you say, I don't like that the MSCI world is so US heavy, you're really criticizing the economic landscape, not the ETF. The index simply mirrors what the world economy looks like today. And about the tech dominance, Yes, Nvidia, Apple, Microsoft, and company have performed extremely well, but that doesn't mean they always will. In 10 years, maybe energy, medicine, AI, robotics, or renewable tech will lead the market. ATFS automatically adjusts, no rebalancing needed. No guessing the next big trend. You invest in the winners of tomorrow without knowing who they are today. Want even broader diversification? Here are two great options. MSCIACWI, All Country World Index. FTSE, All World. Both include emerging markets such as China, India, Brazil, South Africa, Taiwan, South Korea. This gives you an extra 10 to 12% in emerging markets. Even broader global exposure. Will the ACWI outperform the MSCI World in the next decade? No one knows. But both are broad, global, simple, and reliable, and in the end, the most important thing isn't perfection. It's consistency. An ETF provider could go bankrupt. Then what? This is one of the most misunderstood points. Many people think, if the provider goes bankrupt, I lose my money. Nope. Your money is not held by the ETF provider, not by BlackRock, Vanguard, Amundi, or anyone else. Your shares are special, segregated assets protected by law. That means they belong to you. They cannot be touched by creditors. They are stored separately. They survive even if the provider disappears. The ETF provider is basically just the manager. The actual securities, the stocks, are held by a custodian bank. If a provider becomes insolvent, the custodian takes over temporarily. A different, healthy provider usually acquires the ETF. You keep your shares normally. The only practical limitation: you may temporarily not be able to buy or sell. Your shares remain safe. They don't vanish. They're your property. And here's the calming part. ETF providers have disappeared in the past. Investors did not lose money. 5. Synthetic ETFs don't hold the actual stocks. Sounds like a scandal, right? But synthetic ETFs aren't black magic. They're just a technical structure. There are two types. A, physical ETFs. They buy the actual stocks in the index, a simple one-to-one replication. B, synthetic ETFs, swap ETFs. They hold a basket of real stocks, usually large and stable, and swap their performance with a partner bank. This swap allows the ETF to track the index extremely precisely, sometimes even more accurately than physical ETFs. How risky is this really? Synthetic ETFs are heavily regulated. The partner bank must post collateral daily. The basket of stocks must be diversified and high quality. The maximum risk is legally capped. If the partner bank collapses, the ETF takes the basket plus the posted collateral. There might be a small deviation from the index, but no total loss, no meltdown. The only real risk is the so-called intraday risk, a tiny potential valuation deviation on the exact day of a default historically. These differences were tiny, often fractions of a percent. In short, if you like simplicity, choose physical ETFs. If you want maximum tracking accuracy, synthetic ETFs are also absolutely solid. 6. The dollar risk. Doesn't that ruin everything? Currency risk is real, but it's often blown way out of proportion. If an ETF holds 74% US stocks, then if the dollar falls, your portfolio drops a bit. If the dollar rises, your portfolio gains a bit. But here's the big point. Most Europeans have 100% of their financial life in euros, salary in euros, pension in euros, real estate in euros, savings in euros. You're extremely euro-dependent. An ETF with a dollar component gives you extra currency diversification, and that's a good thing. And what do the long-term numbers show? Over time, currency swings even out. They barely affect the total return of a global ETF. They're neither a disaster nor a magic boost. Many investors stress about this way more than they should. If you want to eliminate currency fluctuations completely, you can use hedged ETFs, but they cost more. They're not better long-term. They remove the chance of currency gains. This is why most investors simply use unhedged MSCI World or ACWI ETFs. Wrap up. So now I'm really curious, which of these arguments worried you the most? Which question did you have yourself? Drop it in the comments. I genuinely enjoy reading your thoughts. If you liked the video, leave a like, subscribe, and check out our other ETF basics videos if you want to go deeper. Thanks for watching.